The first problem is, how do you bring that asset on-chain by tokenizing it?
The large VCs are not going to risk all their business. I think from a technology standpoint, we have the ability to create solutions.
Understands that there's a lot of risk nuances when it comes to different chains.
On Web3 technology as a vehicle in capital markets. Yeah, I think that should start just by defining what they mean by Web3 technology when they start. But let's bring the panelists up here. It's a little early. No, we've got 7 minutes. But guys are in the room, hopefully. Got at least one. Come on up. We got one. All right. Keep on coming.
Sí.
This one, you know me? Hello, my name is Sarah Schwartz, and I'm a developer relations engineer at Battle Labs, and I'm going to be moderating a panel today. So our panel is about Web3 technology as a vehicle in capital markets. We're going to dive deep into some of the tech today, and just to sort of set the context, I think a lot of people on this panel agree the tech has been really rapidly advancing lately, specifically for when you think about capabilities for institutions. So let's dive into some of those specifics. But before we do, let's go down the line and do some quick introductions. So you can start.
Hi, my name is Eric Vreeland. I'm the Chief Strategy Officer at Polyhedra, and we're a zero-knowledge infrastructure company. Hey, I'm Alex. I'm the CEO of Aurora. We've already built and launched the simplest solution to launch our own chain.
Hey guys, I'm Abdul. I'm the head of DeFi at Monav. And at Monav, we're building a high-performance EVM layer 1 blockchain that recently went live on testnet.
Hi everyone, I'm Shubham, the head of ecosystem at Mantau. The other force on the largest modular L2.
Yep. Hi everyone, I'm Daniel, the head of DeFi Polygon Labs.
Awesome. Super excited to have everyone here. So just to break the ice a little bit, we're going to start off with kind of a fun question. What is your most contrarian view on blockchain tokenization right now? And is there an under-the-radar trend that you could think of and how we approach institutional investments? I'll throw it out to anyone.
Should I go first? It's okay. Thank you. Awesome. So, as I mentioned, so I'm coming from a public blockchain, which is a layer 2. But for capital market, I'm not sure if someone knows the recent partnership of CK Sync with Deutsche Bank, which is a kind of private blockchain for them to connect with each other. So, for example, the one branch which is in US right now can connect with other branch in other country of the same bank and use a private blockchain. So, first and foremost thing comes to the mind when we talk about capital markets and stuff. The first thing is they don't want to use public blockchain, but the first and the foremost thing. Second, they want to have customized things over there. So, for example, if you want to build something right now, it's very easy for you to develop it on a blockchain. Right now here we have Polygon, Monad and everything. So you don't have to take their permission until and you don't require a support from them. You can easily build anything on them. But for a private blockchain, they will have specific use case. They will have specific tools. They will have specific customizations on their blockchain. How to use it, where to use it, and how much data they want to secure. They want to publicly share it. So that is the first thing, where private blockchain, or maybe in future we see a hybrid blockchain where some use cases can be specific to certain part of public blockchain and some can be a kind of private. I'm not really supportive of private blockchain because it is a centralized thing. But if we want to start, it's not that easy to bring a person to a public ledger directly. It's more easy for them to come to a private chain and then move to hybrid. And maybe in future it can be a public blockchain as well.
Yeah, I can go next. I think that maybe some of the other panels earlier talked about this a little bit, but I think that if we all believe that tokenization of real world assets is going to be a panacea and it's going to solve all these issues with regards to liquidity and demand for these assets, I think that we're going to be really surprised. I mean, at the end of the day, these are just, wrappers around what are pretty illiquid, pretty niche, investment vehicles or securities or whatever they are. If you spent any time watching kind of what's going on with altcoins or what's going on with meme coins, we can already start to see what happens when there are, hundreds or thousands of assets introduced into the market with limited demand for those assets. And so although it may have benefits around, price discovery, at the end of the day, if you're going to put any amount of size into these assets, you're going to have to read through traditional methods. And so I think, although the technology is there, I still think that there is a long way to go before we reach this environment where, these assets are traded with any sort of liquidity and depth on the blockchain.
I want to throw one additional idea here. I do agree with Sufan on the experimentation on the private blockchain side. But if we are going to take a look at the history, how the institution have been adopting the digital assets, it was a struggle for almost 15 years to figure out the Bitcoin ETF, how complicated it can be, right? So my point of view here, a little bit contrarian, is that institutions are lagging, and this is natural thing for them. And taking into account the massive disruption on the verge of which we are right now with AI, there is a version of the world when in 5 years and from now, where the landscape of institutions are going to completely change, and the majority of them are going to die just because of the disruption that is provided by the AI. And I'm not saying that they're going to die in terms of the assets that they own. No, they still are going to own it. But the traditional financial instruments that they are going to change. So maybe this is going to happen, maybe not. Let's see.
I'll go next. So I guess my contrarian take, and I guess it's more of a shit post, is just because you can tokenize everything doesn't mean that you should. But beyond that, I think if you look at what decentralized permissionless blockchains enable in terms of tokenization, it's a huge unlock. But at the same time, one of the biggest problems is a lot of these markets that we're looking to tokenize are illiquid, IRL, and then that property kind of translates directly over to crypto as well. So let's assume you have rare collectibles or any asset that is being tokenized as a non-fungible asset. The question becomes, how do you bootstrap liquidity? If it's illiquid, then it's not really serving a big purpose being tokenized. And I think there's a lot of innovation that's happening in that space right now, especially with a bunch of these AI companies and that are developing ML training algorithms and basically trying to price illiquid assets and make them tradable on chain. So yeah, I think when we talk about tokenization of assets, it's a two-pronged problem. The first problem is, how do you bring that asset on chain by tokenizing it? And then the second part is, how do you bootstrap liquidity? Without liquidity, a tokenized asset isn't really that good within an ecosystem.
Yes, some trading use.
Yeah, so maybe I'll build on what he has just said, and it's a really strong point. You tokenize a lot of assets, and essentially you have billions and billions of dollars on chain, right? But there's no liquidity for any of them. So we do have quite a lot of DPIM projects on Polygon POS, and we kind of face that same problem. It's also pretty interesting because within DeFi, you don't see a lot of engineers being super excited to solve liquidity bootstrapping when it comes to RWAs or DPIM in general. You want to work on the more exciting things, the Panpanes kind of stuff, and staking, etc., more towards the outside of the spectrum. So it's also, it has this issue where engineers aren't focusing as much on this front. And the liquidity on this side of the market is definitely lacking. It also has this, I'm also observing this one point, that is that a lot of issuers are coming into the market and they are trying to supply the market. But the demand, on the demand side, it isn't like super strong. I think BlackRock's bidder definitely made advances in terms of like solving it. But that's just the start for now. Yeah.
Okay. Kind of getting into the weeds here. If you had to choose one breakthrough, be it compliance, scalability, or interoperability, or whatever, that would really accelerate mainstream institutional adoption, what would that be and why?
Yeah, so from my point of view, is obviously compliance, right? So already a couple of talks before on the panel, somebody was saying that the large VCs are not going to risk all their business with a little bit of an exposure to something that is it's not following the compliance rules, right? So compliance is for sure a very strong thing here. And I would like to give a shout out to On the Finance, and they're kind of moving very powerfully in this direction. So that's super cool to see this. And I think that this can be a big win for the whole crypto, kind of getting closer in the compliance and maybe helping institutions not to die.
Yeah, I'll add on to that and pick something that wasn't necessarily on that list, but I also think it's somewhat related to compliance. It's privacy. I think that institutions, they don't want everyone to be able to see, where their money is allocated or what assets they hold or who they're transferring those assets to. They don't want their competitors to see that. They don't want the public to see that. But they also want to remain compliant. So how do you balance this idea of privacy and compliance in a way that satisfies the needs of institutions?
And just real quick to add on to that question, could you say a bit about where this is coming from, versus the institution side versus the tech side? It might be the case that the people, engineers in your chain are thinking this would be the best breakthrough, while institutions are saying another thing.
Yeah, so I worked, as I said earlier, I worked for a zero knowledge company. And so we've had a lot of conversations with institutions that are interested in utilizing our tech in the RWA space for specifically private transactions, whether that's a private or permission blockchain, whether that's on the public blockchain. There's definitely demand on their side to keep this information private, but at the same time remain compliant. And it's not coming just from the institutions themselves, but also from their customer. So, they're acting a lot of times on the behalf of, the people that they manage money for. And those customers don't want their entire portfolio visible to the world. So I think it's coming from, at the institutional level, at the customer level. I think from a technology standpoint, we have the ability to create solutions that work in this way, but it's working with these institutions to understand their regulations and how to be compliant very, very widely across the world. And so how do you build a solution that's flexible enough, customizable enough, so that you can roll it out effectively for these institutions and make sure that, they feel confident that they aren't going to get in trouble and they're going to remain compliant.
And not to eat up a lot of time, just one short comment. I just want to mention to everybody that compliance and privacy, it has a very thin line in between it, and it is extremely hard to balance it. We have a great privacy preserving solution on the Ethereum blockchain. It's called Tornado Cash, but because of some reason, people are not actually loving it, and the majority of Ethereum validators are not accepting transactions with it. It was built with this thing in mind, right? But still, people who have been developing it are prosecuted, right? Good thing is that in Europe they have started to release developers, but still not here in the US, right? So it is a very fine line, and I think this is one of the core issues of the institutional setup, how in general financial world works. It's hard to maintain the balance, and because of this, we hear so many insider stories, insider trading and things like that. So. it's just hard to figure it out.
Yeah, so in my opinion, scalability is the most important thing for proliferation of tokenization and RWAs because scalability equals accessibility. And one of the biggest unlocks that permissionless and decentralized systems bring is allowing access to any person anywhere in the world to transact in a fully permissionless environment. Compliance is something that catches up over time as it's happening at the moment. And then we also see like a lot of regulatory arbitrage happen all across the world. Even some of the biggest RWA issuers are playing that regulatory arbitrage and have entities set up across the world where they can legally operate these instruments. But yeah, the reason why I think like scalability is the most important is because one of the biggest things that's important for accessibility is having a performant network that is cheap, and that the cheaper it is, the more accessible it is to more people across the world. And that's also what we're focused on at Monad, because Monad is a layer 1 blockchain that's building a really performant as well as a cheap environment for people to transact in.
My answer on this is quite similar to you guys. So definitely privacy, and second one is about the compliance. These two questions. So I can explain it in very simple 2 examples. One thing, if you have heard about REITs, REITs, so it's a kind of ETF for offices across the world. So you can buy it on stock market easily. It's a digital ownership, and the earning of that particular office goes as a dividend to all the holders. That was done in Web 2, and that can also be done in Web 3 in the form of token. But now coming to second, privacy. Initially, when ZK was not a thing, Tornado Cash, I'm not sure like if everyone knows about it, but the founders, what happened to them because of North Korea and stuff, like the compliance issue and everything came into it because it was fully decentralized. But with help of ZK, we can tackle it. So for example, right now, we can use ZK identity, we can use ZK proof to prove that if you are a part of that particular BGEM, which is legalized to use it. Second thing, you can prove that you have certain documents and you are the owner of that IRN property. So these are 2 things which we need to sort out at the same time. So compliance will accept when it is more privacy focused and it is not fully decentralized. It should be a part of like hybrid model again, because you need decentralized or maybe a public blockchain or a private blockchain, but it can also be tokenized at certain points. So that's a pretty way where we can compare it, and these both things will go together.
I think most of the panelists have covered a lot of great points. I'm for the ZK point actually, and I think that's agree with everyone here. I'll kind of cover like another piece of the capital markets that's like really not frequently discussed. But in terms of capital markets, we're always thinking about like, hey, going to market in terms of like equities or like pre-IPO and tokenization, right? There is a really large chunk of the capital market piece that's called intercompany financing. So what is that problem? And that problem is that, let's say you are really large, like corporate, right? Let's say you're IBM in Asia, IBM in Europe. IBM in Europe probably owes IBM in Asia $100 million today. And what it is the intercompany financing problem. And that is that the CFOs cannot, between themselves, settle all of the bills at any one point of time. I booked on like a gig like that, and it's essentially in Japan. It's out of NTT. At any one point of time, they had like a couple of $100 million in terms of like outstanding bills that they cannot settle, and they cannot even balance because the group CFO was not like taking a stick to everyone. So I think in terms of tech and in terms of chain, we can even look at stuff like that, because if we actually look at intercompany problems and try to tackle a lot of this other stuff, like we can actually solve them much easier versus like business issues at the capital markets level, which requires a lot more business and negotiations, which takes a really long time. It's not just about the tech. Yeah.
All right, let's get into the application side a little bit. And specifically, I'm kind of thinking about UX and how it's kind of sad to admit, but I think a lot of people here would agree that there's a lot of onboarding education needed for like to use Web3. What do you think is the solution to address this in the context of institutional adoption? For example, will gasless transactions, account abstraction, and interoperability be those key advancements to make all of this more intuitive for people?
If anyone have been here in any of my talks over the past like 7 years, I was always an advocate for great user experience, and now I'm slowly starting to shift my opinion towards let's don't care about user experience anymore. And the reason for this is simple. AI agents are kind of figuring it out, right? We already see AI agents integrating very easily with Twitter and posting something there. There are AI agents that are starting to perform financial transactions already. Again, you already right now on cross-chain solutions, right? And maybe just maybe we don't need to fix the user experience. Maybe we don't need to fix the onboarding. Maybe AI is going to figure it out, and then it is able to convert it into something that is easily consumable for humans. So, but in general, I'm not fully at this point yet. So still it makes sense for humans at least, it makes sense to fix it. And obviously gasless transactions, which is powered by account abstraction, or, some additional interesting mechanics that are allowing users to log into their applications like passkeys instead of seed phrases, and all the stuff. This can be beneficial, but there is a risk that this is going to be beneficial only within the short time frame.
I can go now. On user experience specifically for RWAs or maybe capital markets, so I think so right now it's pretty good. Like we have seen Onto, which has a good product market fit. We have seen Mantra as well recently. I'm not really sure how it's going, but on the website and everything, it's written as like they have a good connections where they can actually bring properties IRL to chain. Now coming to chain abstraction first, because you asked about interoperability. So as when I started, even the UI and UX was not good for me. I used to use centralized exchanges, but later on, because of using and talking to all these other ecosystem dApps, I started using it. But just to mention one thing, even right now for chain abstraction wallets and stuff, I don't usually keep a lot of money inside it. It's a kind of centralized thing, right? As compared to non-custodial wallets. So I'm not sure how people will look on the like chain abstraction, but account abstraction was one thing like which really had a good impact. And I've seen a lot of apps right now using the same thing. Now coming to account abstraction as well. So for example, I have one application. He has one application. He has one application. Each of us are using different account abstraction tool. He will create one wallet for me. I'll create one wallet and this will create another. There are 3 wallets for just one person. So that's an issue right now, even on the backend side. So either we talk about the UI on the front end side or either on the backend side. But still, I think so we need to figure out a lot of things on this particular end. Either it can be simple for users and on backend, we need to figure out all the things, or else users need to understand how to manage these 3 wallets, which are different from each other. So I think right now it's more about how we find the market fit rather than UI, for at least for the RWAs and capital market.
Yeah, I think in general, there's a lot of room for improvement in UI, UX for every dApp that we see in crypto today and like all the different chains. I partially disagree with the whole concept of chain abstraction because for anybody that's been in DeFi long enough understands that there's a lot of risk nuances when it comes to different chains, like even Ethereum and Solana being the biggest chains out there. If you talk to institutions, there's very different risk profiles for the kind of investors that want to put their assets on Ethereum mainnet and the type of investors that are comfortable with putting their assets on Solana. And then, of course, if you go to an L2, which is built on top of Ethereum, but not really a fully decentralized network on its own, then obviously that's a different risk profile. So if you try and abstract those risks away, I feel like that's not probably the best approach. And with all the hacks that happen in crypto, it's always good to make users aware of the kind of risks that they'll see on a risk minimized environment and a risk-free environment or a permissionless environment. But beyond that, I think if you look at any independent chain itself, the UI UX should be improved quite a lot, especially if we're looking to onboard a lot of TradFi people. They're not used to the kind of clunky experiences that we have in crypto, and we pride ourselves on using the kind of things that normal people would not be able to understand, or it would just take them too long. Like a small example here would be CZ, the founder of Binance, like tweeted 2 days ago. He tried to use adapts on BNB chain, and it took him 30 minutes to do his first swap. And this is the CEO of the biggest centralized exchange in the world. It just shows that, like, if he's struggling to use adapts, then we can only imagine what normies kind of go through with that experience. But with a lot of things coming on the AI side, I think it's good that we have agents. Again, I think it's good to have the right kind of risk parameters in place, just so that people understand when they're interacting with different dApps on what kind of risks they present. But overall, there's a lot of room for improvement for UI UX overall if we're looking to onboard more people.
Yeah, I'll just add one comment. I generally agree. I think that, as Alex said, and some others, that AI is going to be the way that we interact with blockchain, I think, in the near future. And asking it to bridge assets or giving it a objective and just letting it go accomplish that is going to be much easier than trying to fix the user experience that we have today. I think by the time we get there, AI agents will be in a place where they'll be able to do pretty much anything we want them to do on chain. We won't have to worry about the UI. But I do think that if this is the case, that brings up a whole new set of concerns that we have to worry about. The security of these agents, they're now utilizing real funds, and we have to make sure that those funds are secure. I think there was an experiment done the other day, asking people to exploit a particular AI agent. It was able to be done pretty quickly. If something goes wrong, there needs to be some accountability and responsibility, and some sort of understanding between the people that are using these agents and the people that are deploying these agents. Like, if funds are lost, who is responsible for that? It's right now, AI is a very, it's black box by nature, and we need to find a way to create some accountability and responsibility for the people that are developing this, so that users can increase the trust we can increase the trust between users and these agents.
Awesome. Yeah, I think we're just over time. Thanks everyone on the panel. Super interesting.
Thank you.
Thanks, Sarah.
Thank you.